distribute the shares, and then if you're in carry and you just hold the shares, you'll realize the same gains. You're not.
Exactly. Well, it depends what happens to the stock price. I guess what I would say.
No, but hold on a second. If the stock were to go 10x and you get 20% of those shares, if there were 100 shares, you had 20. If it 10x, you're still getting 20%, right, Chamath? So it nets out to the same if you hold the shares yourself personally.
This is why I think that if you're in the business of running a multi-fund business, I think you're better off generally. And I think, again, if you talk to the best firms out there, they typically will not try to guess what's going to happen in the public markets. They distribute and they move on to their next fund. And then, because you have to remember, the IRRs, you go through these rough patches, it decays quickly. And all of a sudden, something that looks great can start to look not so great.
And the example of that might be Snowflake or something going down after it went public. And if you had distributed it, you would have booked the win at that high multiple.
Yeah. And then you're thinking to yourself, wow, I hope it goes back up. And then you're like, well, when do I distribute? These are all not things that venture capitalists should be engaged in. They should be there to help build the next David versus Goliath.
I think the counter argument to that is if you really believe in the company and think you understand it better than the public markets do, or because you've been on the board and you have information, if you hold it for another, yes, there's going to be ups and downs, but let's say that you plan to hold it for another 4 or 5 years. You'll still get the same 20-25% carry, but the point at which that carry will crystallize would be at like a much higher level. And so essentially you're preventing your LPs from selling is what you're doing. And so you may get an extra turn of your fund by doing that.
How do we feel as LPs, David Freeberg?
But there's also, isn't there like I'm just trying to pull up the Goldman Sachs report they did in 2019, where they analyzed 4,500 IPOs over a 25-year period. And I think that, and I could be wrong on this, but if I remember some summary of this, I'm trying to find it, so I can't find it right now. But that they basically highlighted that IPOs as an index generally outperform the market over some period of time, whether it's 1 year or 3 years. And so if you have access to those IPO shares, assume you're a venture investor, you can beat the S&P by 10, 15 points, just generally without having any thought about the business itself or the company itself. And participate in 20% carry on the upside from there, or 25% carry on the upside from there. And so generally the rule of thumb becomes, well, you shouldn't distribute right away, you should hold. Is that not kind of a common dogma amongst GPs nowadays?
Well, look at Square. Look at Square. I mean, Square had most of the appreciation happened in the public markets. I think Sequoia held onto their Square shares, did way, way, way better because nobody sold effectively for several years. And the
best firms do this, right? I mean, like we hear from Gurley and others that, they hold on to these shares for years. And, a good business going public has a much better chance of performing well as a public company than, just tracking the S&P after an IPO, regardless of the valuation it exits at.
Well, how do we feel as LPs, Chamath? You're LPs in a lot of funds.
Terrible.
I'm in 15 funds. You want your shares.
I don't know, no offense to any GP out there, but I don't think they're as good of a public market investor as I am. So give me the shares. I'll manage it myself and get out of the way. I give money to to your point, a lot of GPs because I want private market exposure. I don't want them speculating in the public markets for me. I do that for myself. And so I would rather just get the shares and make my own decision. A lot of foundations, for example, are in the situation where they're there to fund programs. So if they have a, multi-$100 million position in a great company, and they can't fund a program or a hospital system can't do what they need to do because some GP is speculating in the public markets, I think it's insane.
Mm-hmm.
So give the LPs the money and move on. It's not your job. Otherwise, you should run a generalized fund. And most people don't because they can't.
Generally, how do you guys, when you are a large owner in a company that goes public, or just say the pool of venture investors or owners in a company that goes public, and the lockup is expiring, typically 6 months after the IPO, and you can now distribute your shares to your LPs, do those, investors take note of or have concern about the impact it might have on the stock price when they're making those distribution decisions typically?
I think they think about that, but a lot of these LPs, particularly the nonprofits, they're forced day one sellers the minute that they get the stock. They just put it out. That's my point. It's
like as soon as the stock gets distributed, everyone's selling and the stock takes a hit, right? And I think the market
there's something happening. This is speculation that I don't have. So just, take it as that. But my understanding was some investment banks went to and Chamath might know the background on this, went to some of the major LPs in the world, I'll leave it at that, and said, hey, you have a position in, I don't know, this cab company. It's going public, it's fully valued, or it's very well valued. Would you like to collar your shares before that? And we will take them off your hands and lock you into a certain price for some percentage of it. Basically, end running the GP's decision-making process. Of course,
there's a lot of that happens. This is why I'm saying I think the GP is better off. If you're in the venture fund business, be in the venture fund business. Do a great job at that. Raise funds, distribute cash, do what you're supposed to do. But please don't try to do something. It's kind of like asking, the firemen to also operate on you. No, I don't want that. Take me to the hospital and let the doctor do their job.
I think it's a very valid perspective. I think it's probably the baseline that VCs should operate from, but I do think there are exceptions where if the VC's been on a company board for a while and feels like they understand the company better than the public markets, especially during the first 2 years as a public company when the markets can be really choppy and the company's trying to find its level and people don't really understand it. I think there is an argument for the VC having expertise in that initial public run, then they might be doing their LPs a favor by holding. But look, I think Chamath's point is well taken.
Also, companies are going public earlier. So this is going to become a bigger issue because it's an easy decision in year 11 if you were an Uber investor or an Airbnb investor to say, okay, it's been 11 years. We're going to give you your shares. But if you're in year 5 and the company goes out so early, you could make an argument, hey, maybe we hold it for 2 or 3 years.